Hey traders, welcome back. Today we're diving into a powerful concept that will help you turn confusing price action into clear setups using candle range theory. Candle range theory might sound basic at first, but don't let that fool you. It's one of the most effective strategies I've come across in trading. What makes it truly powerful is that it's still under the radar. Most traders haven't quite figured out how to use it properly yet, and that gives you a real edge in the market. Let's jump in. What is candle range theory? Let's start with the basics. Imagine a strong bullish candle has just formed. That candle has a high and a low. This becomes the range we'll be watching. Once it closes, there are really only two things that can happen next. Scenario 1. Price keeps moving upward, breaks above the high of that candle, and continues trending. In this case, we stay out. There's no trade for us, just a continuation of the current trend. Scenario 2. Price reverses and starts moving back into the range of the bullish candle. Eventually, it breaks below the low. This setup isn't random, it's something we can learn to spot. When you catch these early signs, you can jump in at the right moment and catch a solid move as the price drops through the range. That's the setup we're looking for. Let's look at some chart examples. Take this bullish candle. We mark its high and low. That's our range. Now watch what the next candle does. If it breaks above the high and keeps going, we leave it alone. No setup. But if it breaks above and then closes back inside the range, that's our first clue. Look closely. Once the price re-enters the range, it often continues to drop, eventually breaking below the low of that original candle. That's a textbook trade. Here's another scenario. A bullish candle forms, but the next candle just keeps pushing up. Again, we ignore it. But now, consider a bearish candle. The next candle doesn't continue downward, instead, it stays inside the range, then pushes above the high. Now we've got the same idea, just flipped. This time, it's setting up for a move to the upside. So, how do you trade this? In each setup, the price has two paths. It either exits the range or trades back into it. At first, this might seem like a 50-50th guess. But here's the interesting part. Let's borrow a classic principle from philosophy, the law of non-contradiction. It says something can't be both true and false at the same time. In trading terms, if price isn't breaking out of the range, then it must be staying within it. And if it's staying in the range, the setup is forming. That's your signal to get ready. Why does this work? Candle range theory taps into the natural cycle of the market: accumulation, manipulation, distribution. The most important part? Manipulation. When price fakes a breakout and snaps back into the range, that's often where smart money is making its move. It's their footprint and our opportunity. Once you learn to spot this pattern, you'll start seeing it everywhere. And when used right, it can be a real game changer for your trading. Validating the setup, zooming in to spot the smart money. At this point, once we've identified a potential range setup, the next step is to dive into the lower time frames. Why? Because that's where we can catch the subtle signs of manipulation, the kind that smart money leaves behind. And when you see it happening, that's your golden moment. It's your cue to prepare for an entry. This manipulation isn't random noise, it's intentional. It's how market makers move price in their favor. If you can recognize the signs, you'll often be ahead of the curve, trading the move before it plays out. Now that the overall method is clear, let's get into one of the most important questions. Which candles should you actually pay attention to? We need to look CRT around key levels, so the higher time frame range candle should be identified around key areas. Another fact is key time. They should identify around the key time. The traditional approach usually focuses on large candles that form during high volume times like 8 a.m. or 11 a.m. when the markets open. And while that sometimes works, it can be hit or miss. So I came up with my own method that's more consistent and tailored to market context rather than just timing. Start by zooming out on the 1-hour chart to get a clear view of the bigger picture. Ask yourself, is the market trending up, trending down, or just ranging? Let's walk through an example. We can see that the price was in an uptrend and formed a nice break of structure just before last week's close. But as the new week started, it began to drop. Here's where it gets interesting. Once I see that candle, I know exactly what kind of candle to look for, not based on the clock, but based on context. And that's what makes this approach powerful. Now let's take it up a notch and look at the weekly structure. Suppose price pushes above a previous high and closes above it. But when we look at the bullish leg on the weekly time frame, we can see that this move is actually a pullback to the discount zone on the weekly chart. Once price reaches the strong FVGs on the daily and 1-hour timeframes, we're expecting a potential reversal. That's a pullback, not a reversal. And pullback candles, they're gold. From experience, I can tell you these are some of the best opportunities. Why? Because price often respects the range of a pullback candle very precisely. It either trades cleanly through it or clearly breaks out, creating a strong reversal. Either way, we're ready. To fully understand candle range theory, you've got to know what a candle is actually showing you. A candlestick has two main components: the body, the space between the open and close; the wick, or shadow, the lines that extend above and below the body. If a candle closes higher than it opens, it's bullish. If it closes lower than it opens, it's bearish. Now, here's what many traders overlook. The body is where the real action happens. This is where market makers step in. They control the open and the close. The wicks, that's often retail noise, stop hunts, emotional trades, and late entries. It's the part of the chart where the market tests people. So, when analyzing a candle, especially a pullback candle, pay close attention to these areas. In a bullish candle, watch the space between the high and the close. In a bearish candle, focus on the space between the low and the close. That's often where manipulation is hiding. This level of detail is what gives candle range theory its edge. Once you train your eyes to spot these patterns and understand the story each candle tells, you'll start to see the market differently and trade with a lot more confidence. Once you've spotted a potential range setup, it's time to zoom in, literally. Drop down to the lower time frames. This is where you'll find the subtle but powerful signs of manipulation, the kind that smart money leaves behind. When you see it play out, that's your moment. These aren't random price swings, they're calculated moves, often orchestrated by market makers. And if you can catch these signals early, you'll often be ahead of the move, not reacting to it, but anticipating it. Now that you understand the core of candle range theory, here's the million-dollar question. Which candles are actually worth trading? Most traders rely on big candles that form around volatile times, like during major market opens at 8 a.m. or 11 a.m. And sure, that can work, sometimes. But it's far from consistent. So I developed a different approach, context over clock. That's where manipulation shows up. That's where market makers leave their fingerprint. This isn't just about spotting candles or reacting to big moves. It's about reading the story each candle tells, who's in control, where the battle was fought, and who's likely to win next. With practice, candle range theory becomes more than a strategy, it becomes a lens for how you see the market. And once it clicks, your confidence, and your edge, takes a huge leap forward. What if there's no smart money footprint? So what happens if we drop down to the lower time frames and, nothing? No signs of manipulation. No clear order blocks. No smart money activity. Well, that's your red flag. It means the setup isn't ripe yet. There's no real manipulation in play, at least not on the time frame you're watching. In this case, stay patient. Keep your eyes on the 1-hour chart. If price breaks below the current range, then it's time to zoom out and reassess. Here's the powerful part. What might look like several messy 1-hour candles, noise, indecision, nothing special, could actually be one clean, structured candle when viewed on the 4-hour chart. That's key. When smaller candles combine to form a larger pattern, we shift our perspective and treat it as a single range candle from the higher time frame. Once we identify this 4-hour range candle, that becomes our new anchor. Back to lower time frames, now we hunt for footprints. With the 4-hour range defined, we head back down to the lower time frames again. And boom, now we see it. A clean FVG and order block sitting right inside the manipulation zone. It's exactly where we'd expect smart money to step in. That's our signal. That's our entry zone. From this kind of setup, even when the chart looked messy at first glance, you can often catch a solid 40-pip move, all because you read the structure correctly and waited for confirmation. And that's the power of candle range theory, combining time frames, reading structure, and tuning into smart money behavior. Sometimes it's not about what you see immediately. It's about knowing when to zoom out, stay patient, and shift focus. Thanks for following along. See you in the next episode.